Hello and welcome to the June 2023 Hogs and Pigs webinar hosted by the National Pork Board. My name's Jess Campbell and I'm a producer in Ohio serving on the board of directors for the National Pork Board. The National Pork Board is a producer-led organization that seeks collaboration with industry experts to distribute knowledge and information to help pig farmers in a wide array of business objectives. Today, we have two economists to disseminate data and analysis of the USDA Q2 Hogs and Pigs report. Please help me welcome Dr. Tyler Cozzens and Dr. Steve Meyer. And in addition, we'll hear from National Pork Board's newly hired Senior Vice President of Market Growth, who is Dr. David Newman, who will touch on the checkoff investments and adding value through market development. But before we would begin, I will review our antitrust statement. Information that's being presented in this webinar includes Pork Checkoff funds that are being used to host the webinar. The purpose is to facilitate your understanding of publicly available information. We believe that the pork industry and ultimately consumers will benefit from a better understanding of the economics of pork production. These were checkoff related funds that are sponsoring this event today. And all the work that the Pork Board does complies with the Sherman Act, and the Pork Board funds that are being used is to help pork producers understand publicly available information. The webinar will be recorded for further distribution, and the views expressed by the guest speakers are theirs and those not those of the National Pork Board. We will do a live Q&A at the end of the webinar, and with that, we'll turn everything over to Tyler.
Thank you, Jess. I appreciate the opportunity to discuss the June Hogs and Pigs report with everyone, and welcome. And with that, I think we'll get started. So next slide, please. So table here kind of gives us a brief update and just some of the key points from the report. To start off with some of the discussion regarding what came from the report, the June 1 all hogs and pigs number came in at 72,394,000. That is actually just above what we saw last year by about 80,000 head. You can see the range of estimates from the pre-report analyst expectations. So actually the all hogs and pigs June number was actually slightly above even the highest estimate of what was expected from the report, which is also above the average of the estimates as well. A couple other things to point out here with the hogs kept for breeding, that was down about 0.4%. That was pretty much in line with what analysts were expecting, was also within the range of estimates, a little bit on the higher side of what they were expecting, but still within the range of estimates. The hogs kept for breeding, 66 million head, 66.2 million head. That was slightly up from a year ago, and actually above the pre-report estimates, above the average and the range of estimates, so slightly higher than what analysts were expecting there on the hog marketing side of things. A lot of that kind of comes from just a higher pig crop. The March to May pig crop was almost 33 million head. That was up almost 1% from a year ago. Much higher than what analysts were expecting. They were expecting actually a decrease of almost 1%, and that is actually above the range of estimates that were expected there. Now on the pigs per litter side of things, saw a significant jump in the pigs per litter from 11 last year to 11.36. That is a 3.3% increase than what we saw last year. That is well above the average of pre-report estimates. We're expecting 0.5%, and the actual is actually almost 2% above even the highest estimate from the pre-report estimates. So a significant jump there and well above what analysts were expecting. On the farrowing side of things, for March to May, came in at about 2.9 million head. That is down just over 2%. And that is actually lower than what analysts were expecting, but analysts were expecting farrowings to be lower, but it is actually slightly lower than even the lowest estimate that analysts had expected. Now on the June to August farrowing intentions, looking at what producers are kind of planning for the next couple of quarters here, we can see that is just under 3 million head at 2.942 million head there. That is down almost 4%, actually well below even the range of estimates from analysts and well below the average estimate there of 97.4. September to November farrowing intentions, again, just under 3 million head, down 4.5%, well below even the range of estimates from the pre-report analyst expectations. So seeing some lower expectations as far as farrowing goes here for the remainder of the year moving forward. Now looking at the market hog category, weight categories there, by and large, the under 50 to 120, 120 to 180 pounds were all up marginally from a year ago. And those were above the average analyst expectations. They were expecting them to be down a little bit less than 1%. Now the hogs weighing 180 pounds and over were pretty well in line with analyst expectations, down just below last year. So pretty much in line with what analysts were expecting there. Now, next slide, please. Now, looking a little bit more at some of these points from the table there, we can see here that the June all hogs and pigs at the 72.4 million head was pretty much in line with what we saw last year, but also is kind of following the decline that we've seen for the last few years here. So not really seeing much improvement there or much further decline as we sit right now. It's about the lowest we've seen here in the last 4 to 5 years, but not too significant of a decline there. So still see where we have a fair amount of hogs and pigs in the inventory levels here. So next slide, please. Now looking at the hogs kept for breeding graphically here, you can kind of see over the last 3 going on 4 years here, we've been on a gradual decline here for the hogs kept for breeding. So this June number of just over 6.1 million head is kind of in line with what we've been sort of averaging here over the last few quarters, but well below the most recent peak that we saw in December of 2019. But generally appears that the hogs kept for breeding is leveling out at about 1.6 million head. So kind of a measured approach to just the breeding herd from the producers here. So next slide, please. Now, sows farrowed, you can see the March to May sows farrowed was just under 2.9 million head. That's the lowest farrowings that we've had on a quarterly basis here, going back to about 2015. So definitely one of the lower farrowing rates that we've seen here. But you know, and even the intentions that producers are signaling here, still around that 2.9 million head, well below what analysts were expecting. You know, that's pretty much indicates kind of the sentiment of producers taking a measured approach to production, watching demand and just market signals about how to manage production and manage their resource base. And I think it also is just a reflection of profitability in the market. And so, you know, producers are watching this closely and making decisions, just trying to gauge how to move forward with production here. And so I think this is an indication where we'll see some lower production numbers as we start to move into 2024. And so that's sort of kind of the signal that we're seeing from these farrowing intentions. Next slide, please. Now, pigs per litter, as I had mentioned, it's a record pigs per litter at 11.36, a significant jump from what we saw a year ago, that 3.3%. You know, that 3.3% increase is the largest we've seen September of 2019. So a large increase in that March to May pigs per litter there. You know, I think that's a positive sign to see that the significant jump like that. You know, the disease pressure has been an issue in the industry and really hindered some efficiency there on that side. So I think to see a significant jump like this is a positive sign. Industry is moving forward. You know, and even although we might have some of the lower farrowing intentions, if we keep this pigs per litter, kind of this production rate going, could see some of this efficiency offset some of the lower intentions. So that could be part of what's going on here as well. Next slide, please. Now, March to May pig crop, that was actually up from last year. and still indicates a pretty good amount of hogs coming through the supply chain. Start to look for those in the later part of this year, and kind of signaling that we should see a pretty good rate of hog slaughter as we move through the rest of this year and into 2024. Next slide, please. Now, June 1 market hogs, 66.2 million head. That was very much in line with what we saw last year, and even slightly below what we saw 2 years ago. Still a positive sign. There's plenty of hogs in the supply chain moving forward, so would expect to see those coming through the supply chain and watch those as hog slaughter moves forward. So next slide, please. Now, looking at the specifically the weight groups that were reported in the Hogs and Pigs report, starting here with the heavier weight category of hogs weighing 180 pounds and over. These are the hogs that we should be seeing coming through the supply chain right now, and as far as slaughter goes, and it's pretty much in line with what we saw a year ago. So slaughter rates, as far as what we should see on a weekly basis, should be pretty in line with what we saw a year ago. Shouldn't see too many deviations from that. So that's one of the things we'll be watching moving forward from here. Specifically with this weight category, is to see if weekly slaughter aligns pretty closely with last year. Next slide, please. Similarly, here on the 120 to 179 pound category, would expect to see these slaughter rates as we move into kind of this third quarter here. Weekly slaughter should be pretty close to what we saw last year. So that's one of those singles we'll be watching here as we move forward in these upcoming months to see where slaughter rates will be, if they pretty close to what Hogs and Pigs is indicating here. Next slide, please. Now, as we look at some of these lighter weight categories, the 50 to 190 pounds and under 50 pounds, we can see they're pretty similar to last year, only slightly above. So that being said, kind of a similar discussion to the heavyweight categories. Would expect to see weekly slaughter rates here as we get further into the second half of the year to be fairly close to what we saw a year ago. Next slide, please. And same thing here on the under 50 pounds, pretty close to what we saw last year. So we're kind of trying to match this up with what the Hogs and Pigs are saying and what we should expect for just slaughter rate as we get through the end of this year. So should expect to see more or less the slaughter activity align with what we saw a year ago. So those are some of the things that we're expecting and looking for as we start to get towards the end of 2023. And with that, I think that sort of wraps up some of the general discussion of just the details and numbers from the Hogs and Pigs report. And with that, thank you, and pass it off to Dr. Steve Meyer.
Thanks, Tyler. Appreciate the discussion of the numbers. Certainly kind of an interesting report with sort of steady as she goes on hog numbers, but a big jump in productivity there that is going to be important to watch in future months. Let's go to the next slide here. I do work for Partners for Production Ag. We are part of the Ever Ag company, a division, and we are introducing brokers for StoneX. We do help people trade in futures and options, and those are risky investments. And so I have to show you this disclaimer, and now we'll go on. Next one, please. Three key issues here. Number one is we're going to talk about Prop 12. That was at one time a political issue and then a judicial issue, and now it's a market issue. And we're going to talk about some timing and implications there. Domestic U.S. level demand has been marvelous, was marvelous in 21 and 22, and it's not so marvelous now. And that's one of the challenges we face. And then finally, production costs, we feel have kind of entered a new era now. The new era isn't $7 corn like we've seen in past months, but it's certainly not $4 corn either. And so we're going to talk about that too. Next one, please. First, Prop 12. A brief history. It was passed by California voters in 2018. It went into effect on January 1st, 2022, and that's important to remember that. A California Supreme Court judge delayed enforcement in response to a suit brought on by California businesses, delayed the enforcement of Prop 12 until 6 months after the enactment of final regulations. This happened in late January of 22. And at that time, CDFA, California Department of Food and Ag, had not published the final regs, and they didn't publish those regs until September 1. So that would have made enforcement possible on March 1st of 2023. We had this little matter of a case that went all the way to the Supreme Court, and the Supreme Court heard that in October, and we waited and waited and waited. And so in the spring, the parties agreed to delay enforcement until July 1, pending the Supreme Court decision. Well, that came on May 11th, and they let Props 12 stand, and that started the clock running for July 1st enforcement. Next one, please. So, we need to remember that Prop 12, July 1st was when the judge's order expires. So Prop 12 will be enforced beginning on July 2nd. There's no delay in the enforcement of Prop 12. Now, any pork produced from that day forward by a U.S. packing plant must be compliant to be sold in California. And produced means meat. So that would be slaughtered July 2nd and after. And they did make an exception for non-compliant pork can be sold in California from July 2nd through December 31st, provided it is in the possession of an end user or distributor on July 1, or is on the premises of an establishment required to have federal inspection and holding an M number designated for a federally inspected facility on July 1. All right. Now, notice I have in possession in quotes there. It was our impression that if you owned it, regardless of where it was okay. And then in a webinar earlier this week, one of the officials with CDFA said, well, it has to be in their location. We haven't got that clarified. So this is another one of these confusing things about Prop 12 that we're going to have to deal with. The non-compliance allowance has driven the cutout value in the last two or 3 weeks. There were some folks kind of took a chance on this and front rented on buying product. And then when it was announced, it was, let's get our hands on as much product as we can so that we can get it into California after July 1. There will be a self-certification allowed all this year until January 1. And at that point, all producers have to be certified through a third-party audit. So if you're a producer listening in on this and you have pigs that will qualify to go to through your packer to Prop 12 to California under Prop 12, you need to be talking to a third-party auditor, certifier, a certifying agent, I think is the terminology, and try to get that lined up. We believe there are about half enough sows out there, compliant housed sows at present. And, that's going to require, if that's the case, then there's about 5% of U.S. production. California accounts for about 10% of our production. Has to find another home after July, whatever, when those non-compliant grandfathered supplies run out. So that's kind of what we know about Prop 12 at the moment, or we think we know. That seems to change pretty frequently, but we do think that there's going to be some market impacts in the second half of the year of some product that cannot get into California that will have to be sold somewhere else in the United States. We did get one clarification last week, though, and that is that smoked, cured, ready-to-eat hams, which most hams that you buy at the grocery store fall in that category, are not covered by Prop 12. The only hams covered by Prop 12 will be raw or green hams going into California, and that would be a minority of the hams that move. Okay, next slide. The cost challenge is significant, and here you see Iowa State University's cost estimates in the red. The forecasts there are mine using the parameters for Iowa State University and futures prices for corn and soybeans. And you can see that with futures where they are now at 5, or where they were last Friday anyway, in the 570 to 575 range on corn and 380 or so on bean meal, we had cost of nearly $94 out through the average for 2024. And that number is 44% higher than where we were in the 5-year period between 2016 and 2020. Dramatic increases, and you can see the annual averages. Last year even higher, or this year was going to be $98. And I want to tell you that this represents the low-cost 25% or so producers. Average producers are going to be $6 to $8 higher than this, and $10 or $12 worse on profitability. And so this is a serious situation for U.S. pork producers at the present time. If we go to the next one, we're watching very closely what happens with this crop. We got them planted extremely well, way better than average, better than most years that we've been in. But this crop condition is off to a very faltering start. I mean, we've actually got conditions, national good to excellent ratings below what they were in 2012 on both beans and corn. And of course, 12 was a short crop because it stayed hot and it stayed dry as we went through the summer. There's no guarantee that's going to happen here, but still we're concerned about it. The next one shows the corn balance sheet, and the corn balance sheet has a little bit of room in there. And that is, we're not going to meet the USDA's forecast for exports this year. Our shop doesn't think we're going to meet those exports for next year, and so that's going to provide a few, maybe as much as close to 1 billion bushels of kind of slack in this balance sheet. Now the problem is if you take 10 bushels off of the yield they show there of 181.5, which is long-term trend yield, that 1 billion bushels goes away just like that. So we think there's a little bit of help here if we can get good crop conditions. And we have rain forecast for the Midwest all of this week and next. And so we think that's going to help as well. Next one, please. Let's go on to demand. Real per capita expenditures is the measure that I use to kind of tell us what demand is doing. And we've gone through 2 great years in 21 and 22. You see all the volatility around COVID in 20, but when we take the total dollars for beef, pork, and chicken in 21 and then in 22, they were record high. But look what's happened in early 23. It's fallen back down toward the levels that we saw below 2021, before 2021. And so we're very concerned of where this stands. We go to the next one. In retrospect, it looks like the driver on the demand surge, can we have there we go, was incomes. And those incomes, of course, came from stimulus payments, added SNAP benefits, a number of things that put lots more money in people's hands in 2020, all the way through really into 2022. And for part of that time period, it wasn't difficult to spend money, but it wasn't real easy in many cases. You couldn't go to a ball game, you couldn't go to a restaurant, you couldn't go to a theater. Maybe the things you wanted to buy weren't available because of supply chain disruptions. So there could be a lot of things that were happening there. And so, a lot of this money went to spend on things like meat. And it was a quantum increase in incomes that really I didn't appreciate enough the magnitude of this income. But when that money came, demand went up, and when it went away, demand has gone back down. And it doesn't take a rocket scientist to figure out there might be a causal relationship there. We go to the next one. It shows you real per capita expenditures by species. Beef fell below its year ago levels a third of the way through 2022 and has been double digits down since that time period. And remember, this is demand. This means that, a combination of quantity and price has brought those numbers down on real per capita expenditures. Pork went below a year earlier levels in September. And of course, we've kind of struggled this year. And chicken was up dramatically the second half of last year, which I would expect for the low price commodity out there, but has fallen since then. So the other point to look at here is that all of these are either above or right at their 5-year averages. So my point about demand is not bad relative to history, it's just bad relative to the last 2 years is quite clear. And if we go to the next slide, you're going to see that even more with this scatter diagram. And we can see that 21 and 22 were well above all of the other observations in history. And yet the forecast for this year for per capita availability of about 49.5 pounds, and the average real or deflated retail price of pork for the first 5 months has been a little over $4.12, where the X is there. And so again, not bad demand, just bad relative to 21 and 22. And so we have to consider that. If we go to the next one, shows you the same chart for, I missed, no, well, here we go. I'm going to talk about exports. Exports were a tough deal in 22 because the Chinese backed out of our market about mid-year. This year, we've seen growth, almost 10% year to date. Our colleague Brett Stewart at Global Agri-Trends has us forecasted up 8% so far this year, and for the whole year. A number of markets have performed very well. Notice that China is not one of them. If we go to the next one, we're being helped a little bit by a cheaper dollar, but that dollar is still above the range that we saw for 7 years before 2022. And so I don't think we're going to get a lot of help out of that. But if we go to the next one, we'll show you the scatter that includes both U.S. consumers and exports to look at wholesale demand. And again, the relationship's the same. Outstanding demand in 21 and 22, and a reversion back to pre-2021 levels in 2023 so far. The next one shows that same relationship at the hog level, and I've marked a couple of X's on there. If you got $90 break even, you're going to have to push demand higher by about 10%, or you're going to have to reduce supplies by about 10% in order to push prices high enough to cover $90 break evens. And remember, I had 94 and change for next year, so those two reductions wouldn't be enough to get that done if we just had to go from where we are now. So the next one shows profitability. That's the same cost line you saw a while ago with actual hog prices and hog futures prices superimposed over it. And this is looking to be one of the worst years we've ever had. In fact, if this plays out like I show it to you here, 2023 will be worse than 1998 was in terms of profitability. And the thing that concerns me most is, given where we stand right now, there's only 2 months of profits into the end of 2024. So I think this is going to drive some large liquidations in the business in order to do this. And if you look at the next one, you can see it, this just stated in a different way of large negatives. About the only good thing I can point out about this chart is that the worst lost pigs are probably behind us. The pigs sold in April, they never had a bite of lower price corn. And notice I didn't say low price corn, I said lower price corn. From here on, they'll get some cheaper corn as they go along. And so I think the biggest lost pigs are behind us. Okay, so the last one, one of three things must happen to some degree to return the outlook to profits. Number one, demand has to improve substantially. So, that's possible, but we need to remember what I think drove that demand was these stimulus payments from the government, and I don't think those are going to happen again. Exports are helping on the demand side, but again, a 10% increase in export only takes about 2 to 2.5% of our product off of our market. And so that's not going to cover the kind of costs we're facing right now. So I'm afraid that we're not going to increase demand enough to get this done. Costs have to fall substantially. We kind of got question marks about the crop at the moment, but if we got rain over the next 2 weeks, we could be sitting on a very good crop that would possibly put these prices down some. But even good crops, I mean, 450 corn, 430 corn, and 350 soybean meal still gives us $90 cost of production. So it's not as if we're going back to the 60s or 70s even on cost of production. And the carbon and biofuels policies that are pushing a lot of this thing on the grain side are not likely to change. And finally, the third thing that can solve this problem is that we have to reduce supplies. And even with help from demand and cost, and I think we'll get some help on both of them, I think this is a given over the next couple of years. I think we're going to have to reduce the number of hogs that are out there. And that's going to be a challenge if we have productivity growing at the rate that Tyler pointed out with those litter sizes in this most recent quarter. So starting now, if we start now and reducing that, we're not going to reduce pig supplies until the third quarter of 24 and maybe even the fourth quarter. And so it's a long-term deal here. And any productivity growth, and especially 3.3% per year, if we were to maintain that for a few quarters, it would eat up more than the first 2 or 3% of sow herd reduction. So with that, I'll stop and we'll take questions and some discussion here, Kristen.
Well, good afternoon, everyone. And I know Steve asked for questions there, and I think we're going to have plenty of time for questions at the end. I am seeing some questions that are coming into the chat as well. So we will have plenty of time to address those either in the chat or as we start to wrap things up. So good afternoon, everyone. My name is David Newman. This was brought up in the beginning. New to National Pork Board, working in the area of demand growth. And If you'll go to the next slide, please. So it's no secret, based on some of the information Dr. Meyer just presented there, we know demand is in a challenging position right now, but that isn't slowing down our development strategy on either export or domestic demand. So certainly there are a lot of things going on in exports, and we work closely with U.S. Meat Export Federation and our partners on looking at growing that demand strategy going through this year and into next year as well. But today, I just put a brief slide in there based on our time to talk more about our domestic market development strategy. And, you know, our demand for strategy right now is really to focus on the long game, building long-term demand for pork, where we grow the base, we grow the share, and we grow the use. So, you know, the question is how are we going to do that? And there's many different strategies, but we have a strong program developed here at National Pork Board that really looks at a few key pieces, which are briefly outlined in this slide. And the first one is to focus on underutilized or underdeveloped cuts, turning them into everyday items, really putting a strong focus on who our key consumer is for pork. Our research, data, and insights show that the multicultural audience here in the U.S. Is going to be part of the future of pork consumption, therefore pork demand. And then also to partner with the closest, those that are closest to the product and the consumers. So working with our packer processors, working with retailers, and working in food service. So, you know, the general strategy is built out in this particular slide right here, where it's about looking at the now of where we're existing. But the question is, what are we doing? We currently have 62 domestic market development activations going on, including B2B, consumer, retailer, food service activations. We have active programs currently going on in approximately 8,000 retail stores, almost 600 food service programs, working across and engaging with those retailers and food service companies on a daily basis. So keeping this top of mind, knowing even where we're at in the market right now, we do think that pork has some great opportunity. The other thing that we're going to talk about is moving into Q4, what's happening. Historically, we know that Q4 has been a strong quarter for ground meat purchases, and we're really going to double down in Q4 in this area to drive volume. So one of those big pushes will be on ground, not only ground pork, but sausage as well. Because if you look at the current market conditions, cold storage report, look at the SNAP reduction that Dr. Meyer talked about just a minute ago, look at the Prop 12 requirements, thinking about the idea that ground products can enter California. When you take all those market conditions into account, there is a huge opportunity here to create incremental demand in those areas. So we've been pushing on ground pork strong for the last couple of years, but we're really going to push harder on it now, moving into Q4. So we're going to create consumer pull-through, working on creating consumer pull-through beyond just price and promotion, and work with consumers where they are, focusing on the consumer of the future as well, whether that is millennial moms, Gen Z, or the multicultural items or audience rather that I mentioned earlier. So, you know, as we move forward into the year, we know that there is a lot of pressure on domestic demand, but we are working hard to really tackle some of those individual programs. We just came off of 2022, where we had the retail benchmarking audit, which is funded by National Pork Board. And when I talk about focusing on underutilized or underdeveloped cuts, one of those examples would be is we're putting a strong emphasis on the loin. So we know that the loin has had a challenge in the cutout for the last several decades at least. And we created a pork loin task force to really start tackling that in terms of innovation and not just volume, but looking at value as well. So a lot of programs going on to try to activate and tackle this demand issue, both internationally and domestically. and be happy to answer any questions and also provide any further follow-up or context for anyone that has any moving forward. So with that, that is the end of what I have for slides, and I think we have time for questions.
Will future quarterly hog and pig reports separate Prop 12 compliant market hogs in those?
No.
Yeah.
That's a pretty easy answer on that one. No. And we're going to be left to kind of guess at how many sows are out there, where that's kind of what we're doing now. So.
Okay, easy enough. The next question is, was there any pork production and hog slaughter activity pulled forward in anticipation of Prop 12? If so, what is the impact looking forward?
I think that's a hard one to judge because we don't totally know. One thing I will say, yeah, the weights trended lower, so they were staying very current on marketings. I will say that, but it's hard to tell if any of this was related to Prop 12. I would argue probably not so much, largely because the uncertainty of just what was coming forth with Prop 12. There's still a lot of uncertainty surrounding that, and so I don't know that producers could really make that sort of a decision to push some of those hogs forward. I would say it's more just a market driven signals. The producers could market their hogs and packers were looking for them, so they're pulling them forward. So I would argue not so much on that front. Steve, do you have any thoughts?
Well, I'm gonna agree with you on one thing. I think the biggest driver was low hog prices and very high cost. And if that's the case, then you don't want to put those last few pounds on that pig. They're the least efficient you're going to put on him, and so save some money. But I do think starting a couple of weeks ago, there was some incentive here to try to get some product in hand, just in case this exemption came along. And of course, in the last week, we've known of the exemption. So I believe there has been, but you're talking, I don't know, maybe 100,000 pigs, over that time period. So I don't think it's going to have a lasting impact on supplies going forward. We're going to get back to our normal current marketings pretty quickly.
What number from the Hogs and Pigs report surprised you the most, and why?
Yeah, as I pointed out earlier in the discussion, that pigs safe for litter is a significant jump. And Steve highlighted some of that stuff as well too. I think that's a positive indication for the industry. And and Steve outlined that very well. Just the pent up production efficiencies that are poised in the industry. And I think that underlies just the resilience of the industry as well, and the progress that they're making. I think we're still in kind of a phase here where we need to adjust some of the production, sort of match some of these things and so forth. So that's sort of the transition that we're in.
I would agree with all that. So we'll just leave that one at that. Tyler did a good job.
This next question will be for Dr. Newman. How do we create pull-through with the ground pork complex? Is it possible to get some crossover buyers from hamburger?
Yeah, it's a good question, and one that's been asked for years is this piece on ground pork. And we can share some data, follow up to any of the participants in this about the focus we've had on ground pork over the last several years, which is somewhat fortuitous now that we look forward, because we were putting a big emphasis domestically on ground pork at retail. The 2022 data that we have shows that we've doubled the amount of ground pork in retail. We also now have box stores and or club stores rather that are carrying ground pork items quite successfully. The crossover from ground beef is a little bit more of a challenge, but what I would say is that when you look at price point and you look at the success of the ground pork campaign, you couple that now with what's going on in California, the market situation that's there, this poses a very good opportunity for ground pork and ground pork items.
The next question is, are you concerned about the packing capacity this fall without Farmer John in Wyndham with the same number of pigs as last year?
I'm always concerned about packing capacity to some degree. And if no, for another reason, those things have been known to burn down or at least have fires that disrupted them. And when you get into a fourth quarter, that's always a problem. It's going to be a little snug this fall. I don't think it's going to be snug enough to cause us any kind of, real price impacts and big delays on getting hogs slaughtered. Working some Saturdays, I believe we can get them all handled. We don't have any huge numbers, and I haven't run my weekly ones. I'm trying to open a file here and look at it. We didn't have real huge numbers going into this, and this report did not change my second half forecast for hogs very much. I mean, the big increase here is going to be beyond that. As I've looked here, let me see if I can come up with a number. Yeah, I think we're going to be okay. It's going to be tight, but I think we're going to be okay.
Are the product-specific task forces that you are working with focused primarily on domestic demand, or are international cuts also a focus for you?
Yeah, that's an excellent question. So taking into account that, we have approximately 30% of the product in the US, right, that is exported here in 2023. We certainly have some big campaigns over on the export side as well. So National Pork Board, we work closely with US Meat Export Federation, as you probably know, and some of those key export markets that were mentioned earlier in the report. So Mexico, Japan, and Korea are a great example of that. We have planned for the remainder of 2023 some retail promotion activities happening with some major retailers, some trade promotion activities happening in Mexico, Japan, the Philippines, Hong Kong, and South Korea. So a lot of focus on this export piece as well for traditional trade, but also looking at loins as well. So one of the big pushes right now in Mexico, for example, is not just on traditional items like ham, but also a very strong focus on pork loin as well. So there is the domestic piece, which I mentioned to you earlier, focusing in on, for example, the loin task force and really looking hard at items that are ground, like sausage and ground pork, which I mentioned a minute ago, but with a continued focus on this export market as well into those key market areas. Happy to share any of that data to the participants when needed. Thank you.
Okay. The next question is, how should we reconcile the improvement in pigs per litter versus the difficult PRRS strains producers have been experiencing?
I think it's a matter of timing. Obviously, this 0144 strain was very, very difficult, but it started about 3-4 years ago now, I think at least 3. And if you look at, at what we normally do on these is we get a new PRRS strain, it about 1.5 to 2 years later, it becomes just brutal. And 3 or 4 years later, we've got some immunities to that strain and things get better. We become better at managing it. We're more careful, and there's a number of things happen, but that kind of goes away, and we increase our productivity, and we kind of get back to pig survival rates that are better for a time period. And then due to the nature of PRRS being an RNA virus, it mutates again, and off we go. And that's kind of happened 4 or 5 times in my career. And so I believe we're kind of on the backside of this strain to some degree. That doesn't mean it's going away, but I think we're managing it better. And that's one of the real contributors to this pig saved per litter. And plus, again, we were trying to manage a wicked strain of PRRS with not enough help. And the two of those, that wasn't a good mix at all.
The next part of that question is, how do you speakers explain why gilt retention did not decline significantly during the March through May time period if the producers are in the worst financial performance they've had in more than 20 years?
That's a tough one, because there's nothing in the data that really gives us a good indication of what gilt retention, what producers are doing. So it's always sort of a little bit of a guess of what's going on there as far as their decisions go. But I would, some of this, my thinking is just goes back to some of the disease pressure. If producers are concerned that they're going to break with PRRS, do they want to have, some sort of gilts possibly in line that they could utilize to maybe fill some of that production gap? I think it's a tough one because, if you still got to feed all those gilts if you do retain some of those. But I would argue just from a facility standpoint, you don't want to have too many empty barns. You kind of keep things moving through there. So I think there's just a lot of factors that could be at play, and it varies from operation to operation, just their decision making, their cost structure, and how they manage their own operation.
Yeah, I would add that one of the big factors here is just financial strength. These operations have come off, a very good year in 21. A lot of them, a lot of producers across the board have had the opportunity to hedge profits and to protect themselves during this time period. And the ones that did certainly have some financial strength behind them. And so, we normally have a year's worth of losses before we start seeing a reduction in supplies. And, if you started reducing the sow herd now, you'd be 6 or 8 months from now before you'd see a lower sow herd. And we really only started this string of losses back in the fall. So I don't know that we're terribly late on lower gilt retention, but I do think that gilt retention is going to go down pretty sharply this fall because those financial resources will probably start running out for some producers pretty quickly.
Do high production costs depress profits per head and Prop 12? Will all these economic factors further vertical integration amongst the large producers, in your opinion?
It takes a lot of capital and resources and an organization to get more vertically integrated. And I don't know that everything that's surrounding Prop 12 is really going to spur things that quickly to really move in that direction. And I think there's still a lot of uncertainty surrounding that. And for a producer to sort of start working their way towards more of a vertical integration, I see that being a pretty slow process.
Yeah, I'm kind of mixed on this. Normally, when we've seen massive changes in the pork industry over the last 30 years, you come out with a more vertically integrated industry on the other side of it. It sends signals more clearly. You increase your competitiveness to some degree. You should come up with products with pigs that fit products better and those kind of things. All those things are vertical integration. There's one little fly in the ointment on that, though, and that is vertical integration involves a strategy of buying corn and soybean meal and selling meat. And at one time, when you made money on the hogs, that was a pretty good deal. Right now, I'd much rather buy pigs and sell meat than buy corn and soybean meals and sell meat. And if you look at the profit position of vertically integrated organizations right now, it's much worse than the ones that are not vertically integrated. So I think the jury's out on this, whether it will actually, what has been the largest sow herd reduction that we know of so far from the largest vertically integrated organization? All right. So I don't think that's a deadlock cinch at all, that's going to be the case this time around.
In your opinion, will packer margins get back to more historical levels if plant capacity is tight this fall?
Yeah, I believe so. Under normal circumstances, the guy with the scarce resource gets paid more, and the fourth quarter is normally the time when packers make better gross margins than they do at other times of the year, and they have enough throughput through those plants that their unit cost of operating their plants are lower. If you got the same amount of labor basically and the same amount of energy and the same amount of everything, and you're killing 2.2 million hogs in July versus 2.6 million in November, you can see that should be more profitable. So I think better times are coming for packers here, especially since we've kind of rationalized a bit of capacity here, not big chunks, but with Farmer John and Prime Pork shuttering those two plants, that should leave them in a little better position.
Well, I believe that concludes our webinar today. Thank you very much to all our speakers, Dr. Newman, Dr. Meyer, and Dr. Cozzens. We appreciate it. And thank you again for supporting the industry with your insights. We sincerely appreciate it and hope everyone has a great day.